You are listening to C-Suite Perspectives, a podcast by the Conference Board.
Welcome to C-Suite Perspectives, a signature series by the Conference Board. I'm Dana Peterson, Chief Economist and Center Leader of the Economy, Strategy, and Finance Center here at the Conference Board. I am also the guest host of today's episode. Joining me today is Malala Lin, Economic Research Associate, also at the Conference Board. In today's conversation, we will discuss the latest Consumer Confidence Index and also what's going on in the global economy. Welcome, Malala.
Thank you. Great to be here.
Awesome. So let's just dive right in. Were U.S. consumers more or less confident in November?
In November, our consumer confidence measure dropped pretty sharply. It fell to the second lowest level all year in 2025. So, yes, consumers are feeling less confident this month compared to last month.
And what has been the trend over the last few months?
This decline in November comes after 6 months of the consumer confidence index moving sideways, meaning consumers were feeling okay. So for a little while, confidence has been relatively the same since May until now. And the last time we saw a sharp drop was earlier this year in April.
So in April, a lot of it had to do with the tariffs.
That's
But what
right.
about in November? Do you think the shutdown had any impact?
It's possible that the shutdown could have had some impact, and we'll talk about it a little bit later when we talk about what the consumers are saying in their write-in responses. But there were some mentions of the federal government shutdown.
Thank you. So let's dive into the details of the report. What are consumers saying about the present situation?
Yes, so in general, consumers were less positive about the present situation. We saw a dip in both of the components of the present situation index. The first of those components being the consumer's assessment of their current business conditions, and the second being their assessment on the current labor market conditions. So, in both of these components, we saw them slip after a slight let up in October. So, as a result, the present situation index reprised the downward direction that started in May.
What are consumers expecting 6 months in the future?
The story here isn't much better. Consumers were notably more pessimistic, especially on their outlook on future business conditions. And there was also a significant pullback in their outlook on their incomes after 6 months of strong positive readings. And as for their outlook on future labor market conditions, it was still decidedly negative, especially if we look at the differential, which is the share of consumers who anticipate more jobs to be available minus the share of consumers who are expecting fewer jobs. So, in general, consumer expectations for 6 months in the future continue to worsen in November.
Wow. Have consumers' inflation expectations changed recently?
Not so much compared to last month. However, the average inflation expectations is at 5.7%, which is much higher than it was a year ago. And overall, inflation expectations have remained elevated all year.
Are consumers still concerned about tariffs? Do you think that's feeding into inflation expectations?
Possibly feeding into inflation expectations, and they are. When we looked at what affects consumers' views of the economy, mentions of tariffs and trade was the second highest after mentions of prices and inflation. And that's the trend that has been for the past 2 months.
Makes sense. Are consumers anticipating recession within the next 12 months in the survey?
The proportion of consumers anticipating recession did increase this month, although there were fewer consumers that think that recession is very likely. So, although there aren't as many strong opinions, the share of consumers who think recession is somewhat likely and those who also think that we're already in a recession, those continue to increase in November.
Doesn't sound good for the US outlook near
Yeah.
term. In terms of buying plans, were there any notable trends for goods?
So I'll start with month on month. Plans to buy big ticket items, including electronics, pulled back in November after not much change since May. And if we look at buying plans on a 6 month moving average, we see a downtick in November. However, they remain above the lowest readings we saw earlier this year. In general, smartphones, PCs, laptops, and TVs were still the most popular future plans. And I also did want to touch on buying plans for homes and auto. We also saw home buying expectations tick down in November, but they are still near 2 year highs. And as for cars, we also saw some softening this month, and consumers continued to prefer used cars over new cars.
Finally, let's talk about services. Were there any notable trends for services purchases?
This month, intentions to spend more on services were down for most services categories that we ask about. And the only two exceptions this month for that decline was for historic sites, museums, and libraries, which slightly increased, and childcare and educational services, which was flat. And this month, the largest drop in spending plans or future spending plans was for streaming internet and mobile services. And I point this out because this is quite interesting. When we look at the top five categories in rank order, streaming internet and mobile services was at number two since June. And this month, healthcare took over that place at number two, jumping from fourth place last month. So the overall trend, I'd say, this year probably seems to be that consumers are increasingly moving towards more necessary and less discretionary categories. I do want to say that I think the trend in future spending plans in general tracks with what consumers are saying about their financial situations. So, our survey also asks consumers how they feel about their current and future financial situations. And it is notable that there was a significant deterioration in May in both of those categories. So, this sort of adds a little bit of color to the pullback we're seeing in future spending plans as consumers view their personal finances less positively, both now and in the future.
Thank you, Malala. Those are really insightful comments that you had about the consumer. We are going to take a short break and we will be right back with more of our conversation.
What does the future of work mean for your employees? How will your company navigate the future of AI? Will there be a global recession? At the Conference Board, our experts translate the latest research and economic analysis into insights and real-time problem solving for your organization. Membership at the Conference Board provides your team with an assortment of knowledge from economics, marketing and communications, governance and sustainability, public policy, and human capital. As a member, you'll have access to our center experts, member-exclusive events, data and benchmarking tools, and peer sharing that will help you understand the present and shape the future. Consider becoming a Conference Board member today by visiting www.conference-board.org.
Welcome back to C-Suite Perspectives. Again, I am Dana Peterson, Center Leader of the Economy, Strategy, and Finance Center, and I'm also joined by Malala Lin, who is our Economic Research Associate at the Conference Board who works on producing the consumer confidence measure. We are actually going to turn the tables, and Malala will ask me questions about our views on the global economy. Malala?
Yeah, so let's start with the highlights. Were there any major changes to our global economic forecast in November?
Not really. Indeed, we still continue to believe that the economy is going to grow by the global economy is going to grow by 3.1% this year in 2025, and then slow a little bit in 2026 to 2.9%, and then tick back up to 3% in 2027. Again, these are unchanged relative to our October forecast.
Okay, so let's take a look at the US economy. Do you see much evidence of tariffs?
Yes, even though we lacked some data, government data during the
Mm,
shutdown, the data that have been released indicate that, yes, tariffs are affecting the US economy, certainly with respect to inflation. When we dig through the CPI report, and also when we talk to our members, many of them are saying, yes, we're seeing higher costs, input costs, but also shipping costs from tariffs. And we are planning to pass those costs down the line. And ultimately, the consumers are the ones who are seeing this. And so that's why we're seeing these effects in consumer pricing.
See, and how are fiscal policies impacting the economy?
Again, we had this shutdown, and from what you mentioned earlier, it did seem like the shutdown itself did dampen consumer confidence, not only presently, but in the future. And we also had our holiday shopping survey, which indicated that
Mhm.
consumers plan to spend less this year relative to last year. And I would also note that our CEO confidence measure also was very weak in the fourth quarter. And indeed, many businesses ranked tariffs as being something notable, as well as looming healthcare costs. All in all, certainly the shutdown had an effect, but there was also a lot of discussion about healthcare in terms of, and also SNAP, which was a food benefit during the
Mhm.
shutdown. But we do know that from the large spending bill that was passed earlier this year, that there will be cuts to Medicaid, which is a program that supports many Americans in terms of paying for healthcare. And certainly the subsidies that are associated with that are at this point, they are expiring. And certainly is a big focus in Washington around what to do about that to make sure that millions of people don't lose access to healthcare through Medicaid. And it certainly impacts a lot of children as well as senior people.
And it sounds like there's a lot at play here. So, how would you think the Fed would respond to what's happening?
Yeah, so what we've been hearing from FOMC or Federal Open Market Committee participants, and they're the ones who vote, many of the governors and the bank presidents have been saying very mixed things. Some of them believe the economy is fine. There's no need to cut interest rates further, given the fact that yes, we've seen less hiring over the course of this year, but we also haven't seen much firing. So most people are still working, and the unemployment rate is rising because there have been layoffs, especially in those areas that have been consolidating, like technology and finance, but also some of the industries that are most directly impacted by tariffs. But other than that, we still see very strong hiring in industries that are suffering from labor shortages, acute labor shortages, such as healthcare. And most other industries are not really doing much. So that suggests that, again, most people are working in the United States and still wages are rising at a pretty rapid clip. Nonetheless, there are these downside risks to the labor market. And so some other FOMC participants are very concerned about that. They're also concerned that the impacts on inflation from tariffs is going to materially slow consumer spending. And we don't really have much of any information on consumer spending other than the retail sales that we got this morning. But again, that was for the third quarter. So we don't really know what fourth quarter
Mhm.
spending looks like. And all indications suggest slower spending, not only this quarter, but next quarter. And so we think that the Fed is probably, despite the disagreements internally, that ultimately at the upcoming December meeting, that they will probably just go ahead and cut rates as insurance.
I see. And so, what's happening? How is what's happening in the US going to affect the global economy?
Yes, certainly the tariffs that have been implemented and negotiated has created a lot of uncertainty. So many businesses abroad are looking elsewhere to see what other markets they can possibly ship their products to. Nonetheless, there have been winners and losers there. So economies that, were already potential alternatives for manufacturing, like many of the ASEAN economies, have been winners throughout this, and also the economies that negotiated lower tariff rates with the United States. But there's still a lot of negotiating going on around the world, including with China, as well as the US's closest neighbors, Canada and Mexico. So there's been a lot of disruption. And certainly there have been winners and losers. But all in all, like I said, we do think that we'll see slightly lower global GDP growth because tariffs tend to shrink not only exports, but also not only imports, but also exports. So that's why we're looking at 2.9% for global growth.
Okay, so let's shift over. It seems like the economic momentum continues to improve in the euro area. So, what is driving this? And what will this result in substantially stronger growth in the region?
Yes, we've actually seen some upside surprises in the euro area. Definitely France and Spain continue to drive a strong growth internally, and it's more than offset the stall that we've seen in Germany. And Germany is lagging behind other Western European economies because they are very much tied to trade with China. And so as China has its internal issues domestically in with respect to demand, that is hitting Germany hard. And also Germany is a major manufacturing hub. But also Italy was a little bit weaker. But all in all, we're seeing better numbers in Europe. And we do think that is going to continue. And certainly, I think the split between France and Spain, Germany especially, has a lot to do with energy. So those other economies weaned themselves off of natural gas from Russia, but Germany did not. And so with the tariffs, not the tariffs, the restrictions on Russian oil has been very negative for the German economy, again, which relies on not oil, sorry, natural gas from Russia to manage their running their factories. So we do think that there will be notably, not maybe not substantially, but certainly faster growth in the fourth quarter, just as we saw in the third quarter, and also next year.
And so, could you summarize some of the upside and downside risks for the euro area?
Sure, I would highlight one downside risk and two upside risks. The one downside risk continues to be tariffs on U.S. tariffs on euro area exports. And certainly there's still ongoing negotiations. I think the negotiations with the UK are over, but there's still ongoing negotiations with certainly the European Union and also individual economies in in Europe. And as long as we have this uncertainty around where the US tariffs are going to land, it is going to it has a potential to continue to cast a shadow over exports from the region. In terms of the two upsides, the fact that the US declared a trade truce with China is actually beneficial for Europe. Certainly because what's been happening is because there have been these large tariffs and disagreements between China and the US, a number of Chinese products have been landing in Europe. That was already going on before the tariff regime. And so there were a lot of concerns about dumping of products,
Mhm.
Chinese products in Europe. So it seems like some of that is potentially stopped now that the US is and China at least have come to maybe not a stalemate, but an agreement, although they haven't finished fully establishing what the new tariff rates look like. And additionally, related to that, China was putting China was imposing export controls on rare earths and critical minerals. And certainly that raises the price globally for those materials. And those materials are super important for anything that's electronic, from
Mhm.
computers to cell phones. And that also impacted Europe. The second positive thing for our upside for Europe is the fact that certainly in the Netherlands, the elections are tilting pro-European and less pro-Russia. And so that could create more stability politically in the region.
So now let's talk a bit more about China. It seems like China will achieve their central government's 5% growth target in 2025. What would you say is driving the growth in China?
Sure, even though quarterly growth has slowed over the first three quarters, so in the first quarter we had 5.4% year on year, second 5.2%, and third 4.8% year on year, it still does seem like China will achieve its 5% target. We don't have a ton of information on the fourth quarter, so it could be slightly slower, but nonetheless, we do think that they will meet that 5% mandate. And if and what's really driving growth in China this year has been the supply side. So
Mm.
basically, investments in industrial company, but in particular, all the things that are pertinent for greening, right? So making EVs and solar panels and those kinds of things. China's been doubling down on that and definitely supporting state-owned enterprises. Where there is weakness in China continues to be on the demand side. So demand mainly points to the consumer, where retail sales continue to fall, consumer confidence is very low, and the housing sector is still in the doldrums. And because the housing sector is not doing well, and it hasn't been for years, consumers are very cautious with their spending. And it's notable in China because there really isn't a safety net like we have in the US or to support consumer spending. Yes, the government has been asking people and prompting people to throw out their old stuff and buy new things, and also giving them discounts and cash and things like that. But nonetheless, consumer spending is still very weak because the housing market has not recovered. And looking at all those things, there's this delicate balance. But still
Mhm.
looking forward, we do think that in 2026 and 2027, China's growth rate will probably cool to around 4.5% from 5%.
I see. And so after the plenary meetings, what is China most focused on regarding its economy? Is it the demand side?
They are mainly focusing on supporting quote unquote new quality productive forces. So that includes things like AI, clean energy,
Mm.
and advanced manufacturing. So it's more of the same. It's more the supply side that they're going to be supporting. But they are working on developing a new 5-year plan. But again, a lot of it's going to be very much focused outwardly, meaning producing the inputs and also the finished products for advanced manufacturing around the world and the greening of the global economy.
Okay, great. Let's bring it back to the global outlook. Could you talk a little bit about some of the downside risks to global?
Sure, absolutely. So when it comes to downside risks, we still have the ongoing conflicts in Europe and also the Middle East. And those are having very strong geopolitical implications, but also big risks in terms of trade and stability in these areas. While the US government shutdown has ended, there's still risk that we could have another shutdown in early 2026. And that certainly, if it happens and it's as longer, if it's even longer than what we just experienced in November, October, November, then that's probably going to put a dent in US economic growth in the first quarter. And that would lower our forecast for next year. Certainly, when you have weak growth in the fourth quarter, it's difficult to make that up, just simply the math on a year on year basis. Also, on the trade front, like I said, US and China are at a standstill, and a deal seems to be on the horizon, but we're not really sure. And the same thing with India. It seems like we are close to a deal, but we still haven't finalized deals with Mexico or Canada, which the US's largest trading partners. So these developments will present headwinds to the global outlook. And the final thing I'll say that's a downside risk is the USMCA
Mhm.
renegotiations take place next year. And that's essentially the trade deal between the US, Mexico, and Canada. And that is extremely important for all three economies because they are just so interconnected in terms of manufacturing and production. And if a company, for example, an automaker, has to pay tariffs as a single car goes back and forth across the border, or it's getting some parts from Canada but it's getting assembled in Mexico and then has to come back to the US, all that raises the price of that car. And so that's super important. But on the upside, many businesses, even in our own surveys, are telling us that they are they're looking at AI as methods to lower costs and increase productivity. And you also have tons of investment in artificial intelligence in the tech sector, and lots of money from abroad also pouring into the US tech sector to support new innovations in AI. And that's going to be positive for everyone around the globe, probably on net and over time. Yes, there will be disruptions, certainly in the labor market, but then there's also going to be a lot of opportunity for workers across the world to be upskilled in these new technologies and increase revenues and thereby their wages going forward.
Thank you for those insights, Dana. That was a great conversation. So thank you for being here with me today.
Absolutely. Thank you.
And thanks to all of you for listening to the C-Suite Perspectives. I'm Malala Lin, and this series has been brought to you by the Conference Board.
You have been listening to C-Suite Perspectives, a podcast by the Conference Board.